So before getting started, this is mostly, guys, an educational, content type of webinar, but we always like to include this dear love letter from our attorney. So we're going to go through some analyses here. You're going to see some, you're going to see words like projections, expectations. You're going to see some analysis here that's derived from other fund performance. Uh, Also, this is everything in here you're seeing is confidential. Please keep in mind that what you're seeing here, this is not an offering of an investment opportunity. If you are interested or would like to learn more about Ironton Capital, we'll include one slide that gives a summary of our funds. But ultimately, please make sure that you are incorporating all of your decision makers in your decision making process. Your CPA, financial advisor, your partner, tax attorney, whoever that may be. Please make sure that you get all stakeholders involved in your decision making process. And so that's essentially what this note goes into detail on. So, quick overview of the Ironton Capital team. It's much larger than three people, but this is the investment team. So you've got Lon Welsh. He's our founder chairman of the company. Started it in 2022 with our first fund, National Diversified Fund 5. Prior to Ironton Capital, he started what is now the largest independent Colorado brokerage, Your Castle Real Estate. Sold that to a private equity company. Also started a title company, First Alliance Title. Sold that to Compass in 2021, right at the same time. So very impressive background, 30 years in the industry. Just really pleased that he started the company and has offered so many, great solutions to investors from an investment standpoint. We've got Brent Geyer on the left-hand side. He's our CEO. Brent's got very deep background, was vice president of acquisitions at multiple different companies, deep background in accounting and finance. And he's completed over $1 billion in transactions over the course of his career. So broad experience at the same time, deep experience in the accounting, finance, and real estate world. And then we've got Richard Landry. He's our chief investment officer. He largely responsible for the modeling of our funds, the underwriting, and the overall investment strategy for the company. And so he's got a background in working at Goldman Sachs. He was in their quantitative analysis department. Was the chief investment officer of a very large family office firm with about $2 billion in assets under management, and has bounced around and worked at multiple different PE companies as a chief financial officer and some other hedge fund companies. So wicked smart, one of the smartest guys I know, knows his way around a spreadsheet, and we're thankful to have him on board driving a lot of the investment philosophy at Ironton Capital. Won't go into much detail here from an Ironton Capital standpoint, the accounting, tax, and audit support. We use Michael Coglinay's. They've got very broad experience in working with shops like ours in doing a lot of their third-party accounting and tax and auditing support. That being said, Joe, I'm going to kick it over to you.
Outstanding. Well, as we get started here, guys, on the right-hand side of your screen is a chat box. If you have questions, please type them in. You don't have to wait till the end. You can type in questions as we go along. If there's anything you disagree with, type that in. Some of our best conversations come from somebody that says, Joe, you're full of BS. What about this? Cool. Let's talk about it. So anything you want to talk about, any questions, you need more clarification. Sometimes I go too fast. That's the feedback I get sometimes is slow down. So if you need that, type that in there. We're happy to do that. So our first slide here talks about average home prices in Colorado. Now, most of the folks that are on the webinar this evening are based in Colorado, but not everybody. So look at your state and see what has happened to home prices since 1991. And we've circled in green the three best, which is Montana, Utah, and Colorado. So if you're here in Colorado and you bought a home in 1991, that home has gone up on average 570% over the last 34 years. Now, that's a pretty incredible return. And maybe you say, well, I didn't buy a home in 1991. I bought a home in 2000 or 2005 or even 2010. So part of what we're talking about tonight is you've probably been the beneficiary of a really big run-up in prices. You've probably been the beneficiary of paying down your debt over a long period of time. And now you have a lot of equity. And so you might be asking yourself, what do I do with this equity? I've got $200,000, $300,000, $400,000, $500,000 of equity. And yeah, the value of the home is still going up. I'm still renting it out if it's an investment property, but that equity is tied up and maybe is not getting you a great return any longer. And so what we want to talk about this evening is, if that's you and you have a ton of equity and you're thinking, how can I make more efficient use of that equity? That's what we want to talk about this evening. Now, what if you would have taken that same money and invested it into the stock market? And so on the left-hand side, you've got in blue the average home price appreciating since 1991 in Colorado, and in orange, the average home price appreciating nationwide since 1991. Well, shows that home prices generally go up. Not a big surprise, right? But what happens over on the right-hand side? What if instead of buying a property, you would have taken that money and just put it into a stock and bond portfolio? And that's the line that you have in green. If you would have bought a property anywhere on average in the United States, you would have done just a little bit worse than had you put that money into the stock market. But if you bought that property in Colorado, look how much better you did. That blue line as compared to the green line. Now, we're not here to tell you take all of your money, put it all into real estate in Colorado. That would be terrible advice, and we would never give that advice. I believe in diversification. I think Nick does as well, not to speak for you, but I think diversifying across multiple asset classes makes a ton of sense. But we show this to illustrate owning real estate is a great long-term investment, and owning real estate in Colorado is a great long-term investment. But now, if you've got a ton of equity in that investment, what are some alternative things that you can do with it? So the first thing that you can do might be taking cash out through refinance, working with a guy like me. So let's walk through kind of a busy slide here, and we're going to take our time on it. But what might be something that you could do? So we're going to start on the left-hand side, and you see property information there at the top left. So let's say you have $250,000 of equity in that property. And the next line there, current value of $475,000. And let's say you're going to estimate that appreciation over the long term is going to be 5%. Now, a lot of people say, well, Joe, how did you arrive at that number? A few years ago, properties were appreciating at 20%. This year, properties are only appreciating at 2%. How did you come up with 5%? Well, here's how we came up with that. Over the last 40 years, home prices nationwide appreciate on average 6%. Now, some years are up, some years are down, some years are better, some years are worse. But on average, over 40 years, homes appreciate at 6% a year. We wanted to be a little more conservative. So we said over the long term, we think homes are going to appreciate at roughly 5%. Now, let's say you've paid your loan down and you've got a balance of $225,000. And you have a principal and interest payment of $1,432. And your net operating income, this is how much this property is making prior to paying the mortgage, is roughly $23,000. That's going to net out to your current monthly cash flow right at $500 a month. So good investment, right? Nick, let me ask you, if you've got a property cash flowing $500 a month, do you feel overall pretty good about it?
I do, yeah.
Yeah, I agree with that. And then you've got your marginal tax rate of 32%. Now, this is a number that's higher for some of us, lower for some of us. But for this example, let's assume kind of right in the middle, 32% marginal tax rate. Now, let's go over to the right and say, what happens over the next 5 years if you don't do anything? Well, your value is going to go from $475,000. It's going to go up 5% a year. And in 5 years, that property is going to be worth roughly $606,000. Your loan balance is going to pay down. Assuming you're making principal and interest payments, you're going to go from $225,000 down to $210,000. The next line down is your cash flow. So you're making roughly $500 a month. Over the next 5 years, you're going to make roughly $29,955. Now, you're going to get a gain from appreciation, principal reduction, and tax benefits through depreciation. So you're going to gain $167,000. So the total over to the right is over the next 5 years, this property is going to make you roughly $197,000. Now, the final number over there in orange is your return on investment in 5 years, and then your after-tax projected return on investment. So after tax is the number there that's a little bit bigger. After tax, you're going to get about a 10% return on this property if you do nothing. If you don't do anything other than continue to rent it, you're going to make $500 a month and roughly a 10% return. So Nick, let me ask you again, good deal so far? Average deal? What do you think?
I would say a little bit above average.
Yeah, kind of about average.
Yeah.
Not setting the world on fire, probably not bragging to your friends, but you're also not pulling your hair out because it's not a terrible deal,
Yeah.
right?
Yep.
Now, what if you said, I like the property, I want to keep it, but I want to do something with the equity? So the next box down, let's say you're going to take cash out up to 75% of the value, and you're going to invest that money into some of the Ironton funds. So you could get a new loan amount up to $356,000. There's going to be some closing costs associated with it. And let's say it's a new interest rate of roughly 7.8%. Well, continuing over to the right, what you see is your loan balance in 5 years is higher, roughly $269,000. Your 5-year cash flow is worse because we've taken cash out of the property. We now have negative monthly cash flow, but our appreciation and our gain on that property appreciation is the exact same because appreciation goes up, principal reduction, and tax benefits occur regardless of whether or not there's a loan on that property. But let's say we now want to take $50,000 of that money and we want to invest that into Ironton. Well, we could take out and put some of that money into the midterm fund, or we could put it into the long-term fund. And what you see over on the far right in blue is how is that, if we were to invest it into the medium-term fund, roughly the same, roughly a 10.79% after tax return. Or if we put it into the long-term fund, which averages a return of 18% after tax, we're going to have about a 14% return. So let me ask you, Nick, is a 14% return more attractive than a 10% return?
Absolutely.
Of course, right? Pretty obvious. And then down in the box on the bottom right-hand side, you see in graph format what happens there. The green line is if you were to take money out and invest it into the long-term Ironton fund. The orange line and the blue line is right behind it. If you don't do anything or you took money out and put it into the medium-term fund, you're going to get almost exactly the same return. So let me pause there and open it up, Nick. Anything I missed on that, if I were to take cash out and put it into the long-term fund, that allows me to get a little bit better return on my equity. Any questions on that or anything I failed to cover?
No questions, but I want to walk through a little bit and clarify here. So
Please.
if you do the refinance at the 75% loan to value, your new monthly cash flow at the 7.875% interest rate is approximately $124, negative $124, right?
That's right.
So if I go to the section that says midterm fund investment for break even cash flow,
Yeah.
that's the amount that I would need to invest to supplement the new negative cash flow, correct? So I could take the 12,000, put it in the midterm fund. I've now resolved my negative cash flow problem. And then I can take that remaining and put it into the long-term fund at the 18% for 5 years. So is that the proper way to read this for our attendees?
That's exactly right.
Okay.
Because negative cash flow, nobody likes that, right? Nobody wants to have a property and now I've got to be subsidizing it to the tune of $124 a month. And so that's exactly why we've got that line there is, hey, I still want to be cash flow neutral. I want to have no cash flow coming out, but I don't want to be putting money in. In this example, if you were to take $12,436, put that into the medium term fund, that's going to pay me on a quarterly basis, which negates my negative cash flow. So now I'll be cash flow neutral. And the remaining amount is what I can put into Ironton, either more into the medium term fund or more into the long term fund to, again, get a better return on that equity.
Yep. One other thing I wanted to point out, I think we've been doing this webinar for about a year and a half now, and it's interesting because the interest rate actually has not changed at all. In fact, I think the last time we did it, we said 7.5, and now we're at 7.8. So I think we want to highlight to the impact really of what this interest rate environment has done to leverage,
Mhm.
because you might not be able to strip out as much equity as you once could, as you can clearly see by the negative new monthly cash flow. So keep that in mind if you're evaluating, hey, do I do this refinance? What does that look like? You're likely going to need to keep a lot more equity in the property.
Yeah. Yeah, you're exactly right. We have seen cash flows go up at a lower pace then interest rates have gone up. So a lot of times we'll sit down with somebody, and 7.875, that's kind of middle of the road, right? That's assuming average credit, average equity. I did one of these just yesterday that closed for a client. He got a rate of 6.875. I also did one last month for a client, a little bit worse credit. It was at 7.99. So it depends on some of your individual scenarios. And that's a big part of Nick's job. And my job is, if you say, hey, I've got a lot of equity, well, we're not just going to send you this. Hey, here's an example. We're going to get on a phone call with you and say, hey, walk us through the details of your property. Let's look at what does it look like for you. Maybe you have more equity, maybe you have less, maybe you have really great credit. You're going to qualify for a lower interest rate. So there's lots of different levers that can change here. This is just an example to start getting the attendees familiar with how you can get a better return on that equity. So none of this is set in stone. And I make one guarantee, it will be different for you individually versus this example scenario. So such a great point there, Nick.
Yep.
Cool. All right. Any questions on this? I didn't see anything in the chat box, but if you guys have questions, type them in. Now, a real common thing that Nick and I will hear is, Joe, I definitely want to get a better return on my equity, but I have a 3% first mortgage. Why would I refinance that to 6.875 or 7.875 or whatever? Well, let's talk about that. What if you said, instead of doing a first mortgage cash out loan, what if we were to do a home equity line of credit? So now our top section here is all in gray because that's all exactly the same. Nothing has changed there. Well, what we've said now is let's do a $50,000 or take $50,000 out in the form of a line of credit on our investment property. Well, what you see in yellow, the HELOC interest rate is always going to be a little bit higher than a first mortgage. But to take $50,000 out, we're actually still going to be cash flow positive by $138 a month. So what can we do now? We can put that money into the medium-term fund, and now we're getting a cumulative return on the far right of 11.6%, or we could put it into the long-term fund and get a cumulative return of roughly 15.37. And so when you look over on the right-hand side, the bottom chart there, the orange line is what happens if you do nothing. You stay at that 10.7% return. Again, very good. If you like that, we're not here to tell you you should change anything you're doing. That's a great return, but maybe you could get another 1% or maybe even another 5% if you were to take out a HELOC and then invest that money into the long-term or the medium-term fund. So Nick, let me ask you, do you see more folks taking advantage of this option these days?
I would say yes. I do see a little bit more activity on the HELOC side.
Yeah.
Yeah.
I see a mix. I'd say it's about 50-50 because there's a little bit of risk with a HELOC that interest rates may go up, and that's going to eat into my cash flow in the future. But some folks that are concerned about interest rates may still choose the first mortgage option and just have all of it on a fixed rate. So there's pros and cons in either scenario. Again, kind of comes back to, if you've got a ton of equity, call Nick, call myself. We'll go through this exercise with you and say what might make sense here. Now, questions on that or anything you want to add there, Nick?
Yeah, I did want to keep in mind, I believe, right, Joe, this assumes that, we're gonna get the HELOC and we're just gonna make the minimum interest payment or the required interest payment per month, right?
That's right.
So if you're a high income earner on this call, maybe you've got a W-2 job, you've got a couple of rental properties. What we're not assuming here is that, you might get this HELOC and then deploy the capital and then maybe chip away at the HELOC and reduce your principal balance and therefore reduce your interest expense.
Yep.
So, there's a lot of flexibility with the HELOC. I mean, I have a HELOC, and I think that's why I like it. I have that flexibility to maybe make a big payment on it, reduce my interest expense, and deploy capital as needed. So I wanted to point that out as well. As it is a line of credit, so you do have more flexibility in that regard. And I also believe the less leverage with a lot of the local banks and credit unions, if you go with a lower leverage, you might be able to get a better interest rate. So I've seen interest rates in the, usually around the 7%, 7 to 7.5%. If you're somebody that has a bunch of equity, especially if you've got a free and clear property, it might not make sense to cash out refi. But you might be able to go get a HELOC and get a rate of about 7%. with a 10-year interest only period. So you've got even more flexibility if you've got a ton of equity built up in that property. And I think this is where it usually makes the most sense, going the HELOC route.
Yeah. So I'll tell you a quick
Yeah.
story, because you hit the nail on the head. If you've got other ancillary sources of income. So I have a client who recently came to me, and we took $200,000 out on a HELOC against one of his properties that's free and clear.
Mhm.
He has 4 other properties plus some additional passive investments that pay him $12,000 a month through, these various mechanisms that he has. And, one is like 2,000, one is 2,500, but the total is $12,000 a month. And so he decided to take out $200,000 on a HELOC, put that over into the Ironton medium term fund. And he borrowed that money at 8% on the HELOC. The medium term fund pays, at his level of investment, with his other investments, pays 12% per year. So he's making a 4% spread. He borrowed it at 8, deposited to the medium term fund, which pays 12. So he's making a 4% arbitrage, if you will. And then he takes that $12,000 a month from his other investments. He doesn't need that money to live on, and he applies that towards the HELOC to pay it down. So he has interest of about $1,500 a month. So the first 12,000 goes towards that. The remaining $10,500 goes towards the principal. Once you plug it all in, that line of credit is going to be back down to a zero balance in
Mhm.
18 months. And he's got $200,000 over in the Ironton medium term fund that's now paying him 12%. And his plan is, once he gets that HELOC down to zero, take another $200,000, put it into the Ironton fund, take the cash flow, pay it back down on the HELOC, and just recycle that money over and over and over again. So over the course of the next 6, 8, 10 years, he may have as much as $400, $600,
Mhm.
$800,000 in that medium term fund. And he's spent money, right? Because it's coming from his cash flow, but it's not money he's truly taking out of his pocket every single month. Does that make sense?
It does, yeah. Hopefully over the same 10 years, the Federal Reserve lowers their benchmark interest rate. And if that does happen, your HELOC interest rate, which is variable and usually tied to the prime index, which is tied to the Federal Reserve, as that comes down, your interest rate comes down. So that arbitrage grows, hopefully, over time, at some point when interest rates do go down.
That's exactly right.
Yep.
Now, I want to talk about our third scenario here, and I really want to get Sean involved. We've left him out for like 25 minutes. But what if you say, you know what, I don't like this property. The thing is haunted. I have trouble, putting a tenant in there. There's always repairs. There's this issue, that issue. I just really want to sell it. So we have an analysis that Nick can walk you through on what would it look like if you were to sell the property. So our top section, still all the same. And now in the middle part of this page, what if you were to sell it? So you originally bought it for 275,000 back in 2022. You've utilized about $17,000 of depreciation. You're going to
Mhm.
have some costs to sell. You're going to have some real estate fees, other miscellaneous costs. And then the big one you're going to have is capital gains. You're going to pay almost $30,000 in capital gains when you sell this property. So in this case, now you're going to walk away with $186,000. And if you decided to invest that into the Ironton medium term or the long term fund, over on the far right hand side, the medium term fund, you're going to be getting about an 8% return. In the long term fund, after taxes, you're going to be getting about a 14% return. So you might look at that and say, well, if I do nothing, I'm getting a 10% return. Maybe I don't want to do that medium term fund, but maybe I want to sell it and put that money into the long term fund because that's much more passive. It's going to grow at a faster rate. This could be a good option. So, Nick, have you seen some clients do this where they sell properties and then invest the proceeds into Ironton, into one of the various different funds?
Yeah, absolutely. And one of the things I always like to try to understand is like ultimately what is your goal? You might be a, retiree, you're selling your rental properties and all you want is income. You don't
Yeah.
care about growing your equity for the next 10, 15 years. You want to replace that cash flow. So maybe
Yeah.
that percent return like we're seeing here isn't as important, but you're saying, "Hey, I've got 500 a month in cash flow. I just need to match that. And if I can match that with the midterm fund, I can put the rest in the long-term fund if that's what I want to do." There's many different levers you can pull. So that's always something I like to understand. Is cash flow your priority, or is the growth of your equity the priority? Or is both at the end of the day?
Yep.
Um, if you go into the National Diversified Fund, we have what's called a depreciation share class. So while we can't fully mimic a 1031 transaction, you can come into the National Diversified Fund. We should be able to get, with the recent passing of the tax bill, of your investment about 30%, 20 to 30% of that in depreciation that you can use. Again, we're not CPAs. Please confirm with your CPA. I'm speaking with how I've seen it done. You can take that 30% depreciation and use that as a direct write-off against the capital gains. You can significantly lower your tax bill by investing in the depreciation um, share class of the National Diversified Fund. So you won't be able to fully mimic the 1031. Unfortunately, if you did take a lot of depreciation on your rental, you will not be able to offset the depreciation recapture that comes along with that. And so I talked with so many investors, and a lot of times their priority is, yeah, I've just been doing a 1031, for my entire life, and I want to keep it rolling, because maybe they're going to have a very large tax bill, or they're going to have a very large depreciation recapture expense. And so ultimately, that's why we have Sean on. And we'd really love to hear, Sean, we'd really love to hear you walk through what does that process look like for an investor that they don't want to go completely passive. They just want to do a 1031 transaction, keep the equity rolling, forget the taxes. They come to you. What does that conversation look like?
Sure. I'll do some table setting here. I'm hoping that most of the people on this call have some just a passing familiarity with 1031, but my experience tells me that's probably not true. The 1031s, even though they've been around a long time, and even though they're in many circumstances a powerful tool, education about them is either non-existent or sparse, or oftentimes things that just aren't so. So taking a step back, 1031 exchanges are a special carve out for real estate investors that the IRS provides. And all state departments of revenue provide the same option here, where you can tell the IRS, look, I'm not actually selling my investment property. I'm just changing the shape of my investment. What that looks like is I'm trading out of this property, taking my equity and putting it into a new asset, a new piece of real estate. And if I follow the right procedures, then the IRS will sprinkle their holy water on that procedure and say, okay, you don't have to pay taxes on that sale. You don't have to recognize the income. You get to roll all of your equity into the new investments as if you never sold the property before. Now, there's a lot to be said about the positives and negatives of doing 1031s. They're not a panacea. It's very powerful to be able to keep all of your equity working for you over a long period of time. And there's no limit to the number of exchanges that you can do at a time, in a tax year, or in an investing lifetime. So as Nick mentioned, sometimes you'll have people that start 1031ing when they're 20, and they'll have a bunch of completely depreciated assets that have been 1031 exchanged over and over and over again, and through all, lots of doors and lots of different types of real estate assets. If they ever liquidated that and disposed of those assets, they'd have an enormous tax bill on their hands. So the way a 1031 exchange works in practice, and take a step back here, the company that I'm the CEO for, 1031X, is what's called a qualified intermediary. That means we facilitate 1031 exchanges. That's all that we do. You have to use a company like ours because the IRS says so. We're a creature of the tax code. You can't do a 1031 exchange on your own. So someone comes to us and they say, I want to roll out of this property. And unfortunately, in the state of Colorado, we're hearing this story more and more and more, where somebody says, it used to be fun being a landlord here. There was a lot of places that we felt there was comfortable appreciation. It was easy enough to manage, a lot of demand for people moving into the state. It was always easy to find tenants. But then starting about a couple of years ago, the state legislature started passing rules that made it a lot harder to be a landlord in Colorado. So what we're seeing are people saying, I don't want to own my Colorado real estate anymore. It's too much of a headache. I don't like what's happening here. I'm going to go reinvest elsewhere. They have to get us involved prior to the sale taking place. We do a little bit of legal jujitsu to turn their sale into an exchange. And then what ends up happening is when the property sells, the proceeds from the sale, the equity trapped in the property, goes into a bank account that we hold on behalf of the investor. And then we hold it until they find something else to buy. At that point, we make sure the funds arrive on time as down payment on the new property. There's a couple of points here I want to mention about 1031 exchanges that relate to what Joe and Nick were talking about. The first is on depreciation recapture. So 1031 exchanges defer long-term capital They also defer depreciation recapture. And on the point of depreciation recapture, it's worth noting, even if you don't take your depreciation, the full amount of depreciation you could take while you own a depreciable asset, the IRS can still tax you on the depreciation you could have taken. So this
Really?
is it is a little known fact, and most of the time it doesn't happen. And the reason it doesn't happen most of the time is because most accountants either know this and don't report it accurately or don't know it. But the IRS technically says we're going to tax the depreciation you were eligible for, not just the depreciation you actually took. So you could
Wow.
end up getting a tax bill that you didn't actually get the tax break for to begin with. So word of warning to all of you, go talk to your CPA, make sure you're taking your full depreciation every single year and getting that tax benefit, because there's some chance that the IRS will ding you for it even if you didn't get the benefit. The other thing I want to say about your tax liability and exchange is it isn't eliminated with a 1031 exchange. That's really important to stress. If you defer taxes on the sale of property A and go into property B, if you dispose of property B, your basis in that property has carried over from A to B, and you're still going to end up paying that tax when you sell. Now, sometimes it's useful to say, maybe I'm invested in Hawaii and I don't want to pay Hawaii state income taxes, so I'm going to exchange out of Hawaii and go to New Hampshire where there is no state income tax, and then I can sell in Hawaii, in New Hampshire in a few years, and I don't owe the state of Hawaii a whole bunch of money. That's a less and less useful strategy because many states are getting wise to that. California, as always, is leading the charge and trying to soak taxpayers, and they have what's called a clawback provision that some states have copied to make it harder to do that. But in any event, one of the benefits of an exchange is that you get to help time when you want to face that tax exposure. Another potential benefit of an exchange that isn't immediately obvious is if you have a large real estate portfolio and you die, your heirs get the property at a stepped up basis. And that's one way to ultimately eliminate that tax liability rather than just defer it. You don't get to enjoy the benefits of that, but your kids might. However, there are some important limitations. 1031s come with strict timing restrictions in terms of how quickly you have to identify what you want to buy next and how quickly you have to buy what you want to buy next. Restrictions in terms of ownership structure, restrictions in terms of geography. Now, you can trade out of any state into any other state, but we do have some investors that want to say, go buy in Puerto Rico. You can't do that if you're selling, say, in Colorado. And they're also, you're stuck in directly owning either the fee simple interest in real estate or some other type of what's classified as direct ownership of the underlying real estate. That often comes with management headaches. One of the things that we've seen an enormous increase in appetite for over the last 8 months has been people looking for passive income. They're tired of handling everything on their own. It's possible to get 1031 eligible assets that give you passive income, but most of those come with some downsides. For example, you could trade into mineral rights. You could trade out of a single family rental and into oil and gas properties and get royalties from what's being pumped out of the ground, but you're dealing with the fluctuations of the energy market at that point. Or you can trade into what's called a Delaware statutory trust, which gives you passive income, but DSTs are notoriously illiquid and a little bit opaque, and you have no idea when you're going to be able to get access to that capital again. So if you are looking at a spot where you're going to need some cash flow, or you need some access to some cash, or you're going to need access to an asset that isn't going to require a lot of maintenance on your end, is usually worth looking at other options besides a 1031 exchange and evaluate both at the same time. You don't just want to reflexively think, I'm going to sell real estate, or I'm thinking about selling real estate, or I'm tired of managing real estate, so therefore I need to do a 1031 exchange. I wish it were true that 1031s were so wonderful that you always needed our service. That's not in fact true. Sometimes it's the wrong move for you, or you can split. One thing you might consider doing is you could trade into, there are certain types of passive portfolios. This just struck me, Joe and Nick, but I think it actually fits quite well. You could trade into a passive diversified real estate portfolio that is 1031 eligible. There's a couple of those out there that allow for a quick refinance right after. And with something like that, you get access to loan proceeds. Loan proceeds are not income, they're not taxable. It does not invalidate your 1031 exchange if you refinance quickly after you buy the replacement property. And then after that, you can take those loan proceeds and reinvest them possibly into one of the funds that Nick and Joe have been talking about here just one of many options. And I think I'll pause here after this, but the takeaway I want people on the call to have is that 1031s are a lot more flexible than you might think, and they can fit lots of different fact patterns. Just because that's true, however, it's really important to think through what you would do if you didn't do a 1031 exchange, and then compare what the net result is going to be in those scenarios.
Excellent.
I love that. What you said there is, there's a lot of different ways. And I love what you said, Sean. There's no one size fits all, right? And I think that's one of the reasons why we're so excited to have you here is Nick and I take a very consultative approach. Clearly you do as well. So let me ask you this. Let's say I'm an investor that's an attendee on the call, and I have a property that I've owned for 10 years. And I'm looking at this and like, yeah, I really like the Ironton medium-term fund or the long-term fund. But on the slide here, the difference between the orange line at the bottom right-hand corner, the difference between that orange line and the blue line and the green line in the bottom left corner, bottom right corner, that difference is the amount of tax I'm going to pay. If that attendee meets with myself and Nick, and that number is $100,000 of taxes or $200,000 of taxes, would you be open to having a conversation with the attendee? And we say, hey, you know what? I really like Joe, really like Nick. I like what they're talking about. I want a better return on my equity, but I don't want to stroke a $100,000 check to the IRS. Is that something you can help us game plan and say, you know what? Maybe it is a good thing to pay that IRS. Maybe it's better to 1031 and then do a cash out refi. Is that something you could help walk us through?
It is. It's the kind of thing that we do all day, every day. And that's the kind of scenario, frankly, that it's why we do what we do. I mean, 1031s in and of themselves are not an inherently sexy or fun topic, but getting to work with interesting people on interesting problems who are trying to do useful things with the assets they have, that's a ton of fun. So we absolutely can do that. I would stress to that investor on the call that you're going to face the tax burden almost certainly at some point. So it's not just thinking through, am I going to pay the tax or not? It's when am I going to pay the tax, and why is that the time that I should? That's a really important thing to have in the back of your mind.
Yeah, I think you're so spot on. 1031s do not eliminate taxes. They just kick the can down the road to some undefined point in the future, right?
That's right. And my business partner, Steve Hickox, likes to say that 1031s are like an interest-free loan from the government. They say, I know you owe us, but we're going to let you keep that money at a 0% rate, in perpetuity until you do something that we don't approve of in terms of selling without doing an exchange. It's a useful tool. And again, to reiterate, it's not a panacea, and you really should work with, one or multiple people that can help walk you through and game plan how to go from A to B in the most tax efficient way possible, provided that it still actually hits the goals that you have. You don't want to exchange just for the sake of exchanging.
Yeah, I think that's super smart. Well, let's look at an example scenario here. So this is a property that Lon had here, and this is an Airbnb property that was in Colorado Springs, and he purchased the property back in 2020. And what he noticed was coming through, COVID and all sort of things. By late 2024, the performance of this had fallen pretty significantly. Occupancy had gone down. The values were kind of flattening. And if we look here, where's the slide I want? Right here. What you see is gross revenue really took off in the top left-hand corner. He was doing great. But then as we get into 23, 24, that gross revenue was really not that exciting. And the annual return on equity on the bottom left hand really became great. Shoot, 150% return in that first year and a half. But then now he was going down to where he's only getting about a 25% return. And then in the middle, you see nights of booking were going down significantly, adjusted occupancies going down significantly, and then cash flow in 2024 had actually moved to negative. So, Sean, without knowing all of the details, let's just say I've got a property that has moved to not great return on equity, not great cash flow, but I have a lot of equity in the property. Would this be a property that maybe I should call you and begin to explore? Should I do a 1031?
Yeah, that's exactly the kind of property you should explore, because the trend line is this is a less valuable asset for you to hold moving forward. And if you're going to reposition your portfolio, you'd like to be able to do that in a way that doesn't, involve writing a gigantic check to Uncle Sam and the State Department of Revenue. So if you're going to reposition, you want to evaluate, can I do that in a way that limits the skip over the tax paying process?
Yeah. Yep. Exactly. And that's what Lon did here. Is this one was just not an exciting deal anymore. It was exciting for the first couple of years, which is probably true on a lot of rental properties, right? We get them, we fix them up, cash flow goes up. We're like, man, I'm killing it on this thing. But then 3 years later, we look, we're like, oh, now it's just kind of average. It's built up a lot of equity, which is great, but I'm not getting that great return on equity because equity goes up currently faster than cash flow does. And so then you say, well, boy, maybe it's time to reevaluate and do something different. So what did he do? We've got, where is it? Here. He decided to start looking at properties in Florida. And so let me ask you this, Sean. A lot of our attendees are in Colorado. Are you seeing that folks are trading out of Colorado properties into other Colorado properties, or are they trading out of Colorado into somewhere completely different geographically?
This pains me a little bit to talk about. I was born in Denver. There's a Broncos football right above my head here. But Colorado used to be a fantastic destination. We always saw net inflows of investment capital coming from, especially the West Coast, California going to Colorado. That has ceased being true, and now we see a lot of our clients who've been longtime investors in Colorado redeploy their assets to Texas, to the Carolinas, to Tennessee, to Georgia, to Florida. Just what Lon did here, going to Florida. Part of the reason for that is that those are more tax-friendly states, and they're more landlord-friendly states. They're more business-friendly states on the whole. So it's a bit easier to make decisions you want to make with your asset, right? Fewer restrictions on how you can handle the property. The rules in play, when you can kick out tenants that are damaging the property or not paying, are a little bit simpler. The income taxes are either non-existent or much lower, and you're seeing higher cap rates. If that's what you care about, you tend to see a better spread down in some of those areas. Although I will say, the flight from the traditional residential or commercial investment in Colorado to the same kind of residential or commercial investment in the Southeast, the Southeast specifically, that's happening. We're seeing just as much movement out of Colorado into more diversified national portfolios of passive investment, passive income properties. And whether that's through a private equity group or a Delaware statutory trust or some other kind of triple net tick property or portfolio tick properties, we are seeing a lot of that too. If they're going to maintain the same kind of real estate, though, they tend to be going to the Southeast.
Okay. And you said really better cap rates, better regulatory environment, better, we'll say more tax-friendly environment. Any other reasons that you're seeing people leave Colorado, not necessarily leave, but redeploy equity from Colorado to other areas? Any other reasons?
Part of it is a lifestyle shift, and I don't spend most of my or all of my year in Colorado anymore, but Colorado is a more expensive place to live than it used to be. And some people are themselves moving from the state to somewhere else where it's either cost of living is lower or they just think they can find better deals. And if they're going to be moving, their investments tend to move with them.
Mm-hmm. Yeah, I think you're spot on. Colorado, I'm still very bullish on Colorado because I go back to that very first slide that, properties have appreciated 570%, which is, top 3 nationwide. I still love the properties I have in Colorado, but I will say they're harder to find. They're harder to buy. Are we going to have 570% in the next 40 years? I kind of doubt it. Right. And if we were to go back and look at some of this slide, let me go back here. Is it possible that something down here in the bottom right-hand corner in the Southeast has underperformed over the last 40 years and perhaps might overperform for the next 40 years? And I think some folks are looking at that. They're seeing there's not been that same run up in prices, and it might be an opportunity to take from Colorado equity and put that equity in Florida, Georgia, Alabama, Mississippi, Texas, wherever it might be. I think that's a solid investment strategy. I'm not sure I would do it with my entire portfolio, but it might be a good thing to, as we talk about a lot, diversify. Do you agree with that, Sean?
Yeah, absolutely.
Cool. Nick, what do you think about that? You think it's good to diversify maybe from Colorado to some of these other states that have maybe lagged, but might be the beneficiaries in the next 40 years?
I do. I think there's a lot of growth. You've got markets like, Arkansas, Kansas City, Omaha, Nebraska, I mean, it's interesting because I look at California. I was just in California, and it is just shocking. The area we were in didn't have anything less than like $4 million, and it was just amazing to see. And I think at the end of the day, you're having a lot of the people that have been able to afford and acquire real estate over the last 2 decades. They're going to be moving on in life, and they're going to be passing down these properties, or you're going to have a lot of the 12 to 18 year olds that are going to be coming into the real world in the next decade. And it's like, what kind of homes are they going to be able to afford? And unfortunately, we're just not seeing income, at least right now, keep up with. You look at the median house in Denver; it's somewhere in $700,000 to $750,000, and the median income is what, about 100,000.
Yep.
So you're looking at a spread of about 7x, whereas back in the 90s it was probably more like
3x.
three to
Yep.
4x. And so I think that has to cap the amount of appreciation you're going to see in markets like Colorado. And I think you're going to see a growing shift towards people moving to maybe some safer places throughout the Sun Belt, throughout the Midwest, more affordable areas that still are actually very beautiful. I mean, you go to like Northwest Arkansas, there's a lot of beauty there that people maybe do not fully grasp. And so I think that we are going to see a greater shift into some of those markets. I think that'll be a trend that we'll continue to see, and you're going to see people continue to migrate out of California and some of these other states that are just so unaffordable, as they want to start families and go into markets where they can raise a family. I think that'll become increasingly important.
Yeah, I think you're exactly right. Go ahead, Sean.
Wife looking at investment property in Northwest Arkansas. We're actively looking at putting a down payment on a property on Beaver Lake, and it's a beautiful area. Prices have not, they're rising right now. Like it's no longer a super well kept secret, but
Yeah.
it's got a lot of the same qualities that attract people to Colorado, 15, 20 years ago.
Yeah,
Well, we're all, here we are in Colorado, and we mentioned earlier the shift in legislation. You go to some of these Sunbelt markets where the landlord has a lot of the protections. There might still be some tenant protections in there, but you go into these markets where if you don't pay, you're out of there. And it doesn't take long for that tenant to get out of there. It could take a week or less in some cases. And in Colorado, that shift is really elongating that process. And now it's not a week, it's not even a month, it could be 6 months after you've gone through this very complex process of having to evict a tenant, and that could completely just eliminate your cash flow for the last 2 years
Yep.
in a rental property. And so I think that's a very important thing to point out, because that's a key shift that we've seen really in the last year as this legislation has shifted, and it's become more of a headache for landlords.
Yeah, I completely
Yeah.
agree. I mean, the process of evicting somebody in Colorado, even if you have a great property manager like I do, if you can evict somebody in 60 days, they're really, really good. But you need to plan for, 90 to 120 days. And exactly what you said, Nick, that can eliminate your cash flow that you've made for the last 2 years or more,
Mhm.
depending on your cash flow position.
Yep.
So I think this makes a ton of sense, Sean, what you said, that folks are going to more landlord friendly states. So as we're wrapping up here, guys, let's just talk a little bit about how you can get a review, right? If you've got properties that you're not sure, right? Maybe you've got something that has a lot of equity. Please reach out to myself. I'll show you, this is what it would look like if you wanted to take some cash out of that property. This is what it would look like if you wanted to do a home equity line of credit. Reach out to Nick. He can show you, all right, you're taking cash out with Joe. Here's how we can deploy that into the medium-term fund. Here's how we can deploy that into the long-term fund. Or you just say, you know what? I really like having rental properties, but I want to move from Colorado to Arkansas, or I just want to see what is my capital gains going to be like. I think on your website, Sean, you guys have a lot of calculators and lots of tools that we can use for an initial analysis. We can at least plug that stuff in, but then we can call you and you'll walk us through it, or somebody on your team will really help us analyze and understand what we've got in our hands. Is that right?
Absolutely right. And I'm going to risk pulling a muscle, patting ourselves on the back here, but we answer the phone. We've got the best client service ratings in the industry, and we take special pride in walking people through their scenarios in ways that not all 1031 companies do. So please do give us a call. Always a free consultation, always no pressure.
Yeah. And you know what? I will echo that. I have worked with probably 50 different 1031 companies, because I don't get to choose who that is, right? My clients, hey, I'm working with X 1031, whomever it might be. Great. And whenever somebody shows me a contract with 1031X, I am like, thank God this is going to be easy. They answer the phone. They know what they're doing. We're not going to have to wait a week for them to call us back. So I've worked with Sean's predecessor, Chris and Steve, 1031X for, more than a decade. And I can tell you, I've never had a transaction that they don't pick up on the second ring of the phone. I mean, if you're looking to do a 1031, Sean is definitely the person I would recommend. And Nick, you've experienced the same. You've had some rough 1031 transactions for some of your clients, I believe.
Yeah, I actually, Sean, I think it was about 2 years ago, brought a client your way and we sat in on a call, and it was fantastic. It was a great rundown with that client looking to get out of their New York properties and over into Denver. And so an even more complex market to slightly lesser complex market. And it was a great hour-long conversation. So recommend it strongly.
Absolutely.
Yeah.
So, guys, that is everything I wanted to cover. I'm going to put my information in the chat. Nick, if you can do the same,
Yep.
Sean, if you could do the same, and then Sean, any final thoughts, man? We're really excited to have you on here. We want to have you back for future presentations. But what is a closing thought that we should know about you or 1031X or 1031 in general?
Yeah, I'll just say about the company, we're Denver based, right? We're a nationwide company. We have physical offices all over the country, but our headquarters have always been and will always be in Denver. And everybody that owns the company is Denver through and through. We are uh, currently experiencing a lot of people that are considering doing exchanges but are anxious about finding a property they actually like. And if you're in that circumstance, just know that 1031s, even though they're very, very useful, as I'll stress again, they're a really powerful tool, but it's not worth trading into a property that you're underwhelmed by just to get rid of a tax liability, unless you're planning on trading back out of that one sometime in the near future. So call us, talk to us, walk through what the full suite of your options are, not just where you might reinvest. We really just want to help midwife you from spot A to spot B, whether or not that involves our services.
Love that. So thank you so
Excellent.
much for joining us, Sean. Nick, what about you, man? Any final thoughts on things that our attendees should be aware of?
No, I think this slide, I just want to highlight, we do these reviews for investors all the time. And so whether you want to do a 1031, Sean's your guy. They've got calculators on their website. You can do so. And, if you want to run the exact analysis we just showed you, you can go to irontoncapital.com/review. Joe mentioned earlier, we take a very consultative approach. If I tell you that investing with us is not the best option, I will be very blunt and tell you that. I will also do the same if I feel like it is your best option, depending on your goals. And so, do understand that is the approach that we take. And so, we very much look forward to chatting with you guys in the near future.